Guys, how you doing today? Today is February 6th, 2019, Wednesday. And I'm really glad to have you guys here. We're going to get right into the markets and talk about what's going on. You know, we're in something I like to call the calm before the storm. The Fed has been draining $50 billion a month out for quite a while now. And I'll tell you what it's like for me. It's like if a husband told his wife he's going to drain a swimming pool, okay, in the backyard. And he went out and he put a hose in the swimming pool and he started a little pump going and he went to bed that night and he told his wife, hey, you know what, by tomorrow morning the swimming pool will be empty, you know, because he figures, well, the pump's going to run all night and it's going to empty the pool of water. Well, the water's like money in the system. They pumped that money in, basically filling the swimming pool after the crisis of 2008. And and the thing is I was just trying to assess how long is it going to take before that swimming pool gets down enough sufficiently, just like the husband would be trying to assess how long is it going to take. He figured it'd be empty by the next morning. So he comes out the next morning and it's only down 2 or 3 inches. So he has to go back in and tell his wife, you know what, it's going to take longer than I thought. There's more water in there than I thought. And this is what's happened to me in the system. I figured by last summer, I figured they would have drained enough out to cause a crisis. But no, they were able to drain longer. There's more liquidity than I thought. There was inflows of liquidity that's come into the system, capital inflows. It's taken longer than I thought, quite a little bit longer. But, you know, eventually they're going to get there. They keep draining that $50 billion a month liquidity out. Eventually they're going to get there. So let's open the charts right here and take a look at what's going on. January FOMC meeting, Federal Open Market Committee meeting, a pause, but probably not the end of the tightening cycle. Now see, this is showing you that they are doing a head fake. They're just using words to try to stabilize the markets. And in fact, they did. They really buoyed the markets just using words and possibly some action by the plunge protection team. Now, the president said that there were 6 banks involved. 6 banks involved. And they worked together, I guess, to drum up a whole bunch of liquidity that they could inject into the market. And they've done that. They've done that. But how far can they go with that? How far can the government actually go propping up the markets? That's going to have to go on somebody's balance book. There's some balance book they're putting it on. And what's their limitations? As the Fed is constantly sucking this $50 billion every month, ka-ching, ka-ching, ka-ching. I mean, and we're actually starting to see the effects of the drying up liquidity of this. January FOMC meeting, a pause, but probably not the end of the tightening cycle. So they're not going to quit. They're going to continue with this until they bring on the crisis. Basically, this is what it is, because they put this money in after the 2008 crisis, and the money from quantitative easing, $80 billion a month. Now they're sucking $50 billion a month of that same money back out of the system. It's a no-brainer. It's like if a guy comes and puts a table, repairs a table leg, and he basically comes along later and pulls that table leg off, the table's going to fall down just like it fell down originally to begin with. I mean, it's just what's going to happen. So let's get in and take a look at the prices today of these things in this calm before the storm. We're seeing that the markets in silver and gold were fooled too, and they went up, but now they've stabilized. They're doing good, actually, to stabilize and not go down in this scenario where money's being drawn out of the system. Because what that does is, when you draw money out of the system like that, you make less money to go around. And if you got less of something, the value goes up. We see that happening. And the thing is that means it takes less dollars to buy your gold and silver. And so gold and silver prices tend to fall in that sort of a situation where they're raising interest rates and drawing liquidity out of the system. And if we take a look at the gold price here, 13.11, we're moving down $2.90 on the day so far. And the silver price is trying to maintain. It's maintained pretty good in this range, a little bit over $1,300. It's actually holding its own, considering the conditions that are going on. Let's take a look at Bitcoin now. Bitcoin is basically, let me get the chart up here and see. Let's close in on it a little bit. Let's go to the 15-minute. We had a little plunge in price there. Let's go back to the 30-minute. We can see the price is at $3,369. It's been maintaining around $3,400, but we're at $3,369. So we've had a little drop in price, but not very much. It's not at its lowest, at least not right yet, but it's trying to stabilize and create a floor for itself. Bitcoin is. If I gotta tell you, if they continue pulling this money out every month, and if they try to go for another rate hike, we could see a new low in Bitcoin. I don't think it's going to go too much under the, once it gets a 2 in front of it, $2,000 and whatever, 2,900, 2,800, it's going to be much less likely to have that energy to move down even lower. The lower it goes, the more energy it has to. It's easy. See, it's easy for it to drop. When it was up $20,000, it was easy for it to plunge $1,000, $2,000, whatever, But now that it's getting down these prices where it is now, it's getting sticky about moving downwards anymore. You know what I mean? In the same way with gold and silver, because it costs money to produce a Bitcoin. People don't know this, but it costs a lot of money. It's a lot of work to get a Bitcoin. You got to have the right mining equipment, you got to know what you're doing, and you got to take an awful lot of energy or electricity to create one Bitcoin. Let's take a look at cryptocurrency market capitalizations. She's lost a little bit. About a week ago it was 113 billion, now it's 111 billion. Bitcoin dominance of 53.5%. Take a look at the Dow today. Down 1.5 points. Basically, the Dow's not moved any today. It's 25,410. Now let's take a look at oil. Oil hasn't moved much either. It's up 3 cents, or 0.6% at $53.69 for sweet light crude. Oil price, I think right now, I'll tell you what I think. I think that we're going to actually see, if this continues, we could actually see the oil price start to fall again. There's an awful lot of overproduction in the world. And when you get slumping economies in all these countries start to enter in recession. Italy was the first one, but I'm expecting more countries to start to enter into recession. When you see a recession, there's less output. The world has less output. They need less oil. They need less copper. They need less of these different resources because they're not doing so much construction. They're not working. It consumes, the world consumes a little bit less oil. And if oil production increases at the same time, you can get a market drop-off in the price of oil. Let's take a look at bonds and rates today. We see falling bond prices. So we're seeing these capital inflows coming in still. And these capital inflows, are a lot of money's moving into bonds, and this has been happening. I didn't expect it to be so much money in the capital inflows coming into bonds, and I expected these bond yields to pop sooner, but they're going to pop. Eventually, they're going to start popping. In other words, the yields are going to start rising on the bonds because these capital inflows, they're limited. It's limited, and it'll start to dry up after a while. The Fed just cannot continue with this process. It's going to lead to a catastrophe. But they don't know. They're just going to keep going until they hit the wall. Then they'll try to turn around. But it's going to take a lot to turn this around. This is going to be worse than 2008 when it comes, when it finally gets here. Let's take a look at the U.S. dollar index. Like I say, here she is rising. Rising dollar index. Not rising real fast, but it is rising. That's the point. It's rising. Now, what else did I want to go over here? Google News. Why did I have this on here? Oh, something to do with the Fed interest rate hike cycle. Fed Chair Jerome Powell says the case for raising interest rates has weakened. See, this is all this talk. They're probably still going to do a rate hike. U.S. dollar is deepening losses due to difficulty in raising U.S. interest rates in 2019. Well, that's kind of old news. The dollar's starting to rise again, and that's because they're realizing that the Fed is going to start to raise interest rates again. They're not done their tightening cycle, and very soon we're going to actually see the effects of that. Basically, they've pulled off a huge head fake on the markets. They've held their cards. It's just like poker. They've held their cards, and they're keeping a poker face, and they're playing everybody. They're playing everybody. You think they got a good hand? They really don't. It says Fed pivots from hawkish to dovish, signals patience, the new watchword. Fed pivots. See, they're giving it like it's actually happened. It says Fed pivots from hawkish to dovish. They haven't done nothing. They're still hawkish. They've faked everybody. It's all a head fake. They're not going to quit. They're not going to quit until they bring on this crisis. And this crisis is going to be monumental, guys. Monumental in proportions. Thank you guys for listening to this market report, and we'll catch you on the next update coming up very soon. Bye-bye, guys.